Fund managers are responsible for deciding what shares, bonds, or other assets their fund will buy with their investors' money, and for implementing their fund's investment strategy. Broadly speaking, there are two types of investment fund: passive funds, also known as tracker or index funds, and active funds. Passive funds aim to capture the returns of the market at the lowest cost to the investor. Active fund managers, on the other hand, look to beat the market by picking the stocks and shares which they believe are likely to offer a better return than the average. Occasionally, some fund managers manage to do this and build a reputation as a star fund manager. They say this is because they are able to identify stocks that are mispriced. But it's very difficult to beat the market on a regular basis. Share prices are based on all available information about a company and its performance, including historical price trends, company announcements, and annual earnings information, along with the opinions of brokers and computer algorithms. All this information filters through and arrives at a commonly agreed price, and any new information is absorbed almost immediately. Everyone has access to this information, so share prices are very rarely mispriced. This is known as the efficient market hypothesis, identified by Nobel Prize-winning economist Eugene Fama. The efficient market hypothesis states that because all available information is already priced in, it is almost impossible to beat the market. Undoubtedly, some fund managers occasionally do beat the market. But is this down to their personal skill, their star quality, or is it just the luck of the draw? Let's see. Just like any other data, the distribution of stock market returns tends to form a bell-shaped curve, where the highest point of the curve represents the most probable outcome or return, and the lowest points either side represent the occurrences of the highest and lowest returns. The further you deviate from the highest point in the curve, the less likely you are to achieve that return. The vast majority of returns will fall within one or two standard deviations from the mean or the top of the curve. This pattern holds true not just for market returns, but for the distribution of heights, weights, and sports results too. Noted economist Burton Malkiel's random walk theory develops this further. It suggests that stocks act in the same way as a drunken man walking down the street. They are random and unpredictable. Malkiel famously said that a blindfolded monkey throwing darts at the stock listings could select a portfolio that would do just as well as one selected by the experts. Critics of these theories will argue that markets can be predicted. Some stocks are mispriced, and a clever fund manager will spot and exploit these mispricings. But history tells a different story. Research has shown that you have only a 3% chance of consistently beating the market year after year, and your chances of doing well in the short term depend more on luck than judgment. Active fund management costs are much higher too, so even if you do have a good year, you have less chance of coming out on top after charges are applied, making a low-cost, index-tracking investment an even more attractive proposition.